JP Morgan CEO Jamie Dimon has come out saying the economy is weakening. And I know many of you watching are probably thinking, well, duh, but we're going to take a deeper dive analysis with my guest today. Please welcome back to the show, Graham Summers. He is the president and CEO of Phoenix Capital Research. Graham, I think what Jamie Dimon is saying is very much in line with what you have been warning us about, correct?
Yeah, so the big concern really is that the jobs being quote created in the economy are mostly being created in government spreadsheets. The problem that you deal with though is that there's such tremendous political pressure on the Bureau of Labor Statistics to produce, numbers that look better than reality, specifically for things like GDP, inflation, and jobs creation. You get multiple rounds of revisions, and then once a year you get a big revision based on how off the BLS was. This morning, the BLS
Ah,
reported that
right.
as of the year ended March of 2025, they overestimated the job creation by almost 1 million jobs. It was
Can you,
900,
I know.
biggest revision downwards in history, which basically tells us that for the entire last year of the Biden administration, there was no job creation. The Trump administration obviously is trying to turn that around. But the reality is, if you want to get a decent picture of what's really happening in the labor market, you need to look at certain metrics that are not nearly as popular because those ones don't have as much political pressure to produce a kind of nuanced or gimmicked reality.
Biggest revision in history, but
Mhm.
Graham, that just makes you think like, we can't trust these numbers.
Right.
So what is an investor to do? Like, what?
That's something I was ranting about this morning. The problem is trillions of dollars of capital are allocated based on these numbers that we now know have no bearing on reality. They're every month the BLS revises the prior 2 months numbers. They'll do two or three revisions. So usually, like now we're in September, we're not going to get an actual legitimately accurate number for jobs growth in September probably till December. At that point, we'll have gone through enough revisions that they've actually come to reality. But the crazy thing is people are investing based on this stuff, and then the markets don't really, anticipate these revisions.
Okay, so let's get back also to your point about the melt up here is not going to last. What's
Right,
coming won't be pretty.
right.
I know you see many similarities with the 1970s
Yes.
economy. Talk to us about why you're so convinced uh, the S&P is going to come down here. Whoa, let's stop here for just a moment because this is critical. When the next financial crisis hits, accounts will be locked just like 2008, and it will be too late to do anything about it. I've reported on global markets for over 20 years, and what's happening right now is unlike anything we've faced before. The window to act is closing fast, and the opportunity is now. That's why we've created the Private Wealth Playbook. It's free and it shows you how to move into the proper gold and silver strategies, proven to protect and grow wealth when everything else breaks down. Don't wait until after the crisis hits. Click below or go to DannyReport.com and download the Private Wealth Playbook right now. Now back to the show.
So my view is that we're in a melt up and things could get truly silly. The question is how silly they're going to get. It's very clear that the market is beginning to bubble. Valuations are very stretched to the high side. Now, having said that, the economy is technically still growing. The Fed's about to start easing, and they're actually easing at a time when inflation's likely bottoming. Stocks historically are an inflation hedge, at least initially, until inflation reaches a threshold, at which point operating costs rise to the point that profits start getting reduced. So my view is we're going to have some kind of melt up based on how bubbly things are getting and the fact that investors are really looking to hedge against inflation. I think you could see the S&P 500 go to really just, ridiculous number, maybe 7,000, 7,500, something like that. But at the end of the day, the Fed or somebody's going to have to step in because all of these policies are highly inflationary. And that means at some point we're going to have a really nasty hangover from what's happening right now.
Yeah, but if they have to step in, you're talking money printing to the tune of what? Like how much are we
Well, I
talking
think
here?
for certain they're going to have to do yield curve control to try and get the bond market under control. But the bigger issue is if, the question I have really that I've been mulling over in my head is if the economy starts to roll over aggressively and the Fed's really behind the curve, like if this jobs number is actually really dead on and the market's cracking right here and now, then it's likely we're going to see stocks roll over sooner rather than later. The big kind of confusing or confounding issue is that the Trump administration is running a deficit. That's what you'd normally run during a recession at the time the economy's growing. So what's next? They're going to run, depressionary level deficit if the economy starts to roll over. I don't know, but the reality is it's very clear to me that the only path forward involves printing money. And you can see this with gold's reaction. Gold broke out once again against the yen, the euro, the dollar, and the franc all last week. That to me is a big tell from the financial system that the only path forward is devaluation of currencies.
Okay, gold breaking out against every major
Yeah.
currency again, as you say, Graham. And that's why I was so frustrated when I saw this Business Insider headline. I tweeted about it.
Yes.
The headline was, "Why is gold so expensive?"
Hmm.
And I'm just like,
Right.
this headline makes no sense.
Now,
It doesn't pay.
unfortunately, the financial media, they just try to produce content. They're not
Yeah.
actually providing deep insights into anything.
So talk to me a little bit more about what you see in gold's future here forecast.
Well, the reality is if we're going to go back to the 1970s as a proxy, gold went up almost, 1,000% the second round of its bull market. Initially in the 70s, we had a inflationary kind of storm. The Fed thought that it curtailed that by raising rates, but the reality was there was too much money in the financial system. And so they sort of hit pause in the mid 70s. And at that point, inflation ignited again. That's very similar to what we're having now. We had a round of inflation from 2021 to 2022. The Fed aggressively raised rates. Everyone says inflation's been tamed. The Fed paused and it started easing. And now we've got a coordinated easing. You've got the European Central Bank, the Swiss National Bank, all the major central banks easing now. The Fed is now likely to start cutting rates, especially after this bad jobs number. So that's likely going to happen at a time when inflation's bottoming. If you ignore the headline inflation numbers and instead look at the components, look at the things that comprise the consumer price index, the percentage of components that are now clocking in at an annualized rate of 3% or higher is like over 2/3. So we've got a very broad inflationary impulse appearing in the data. It's just that because of all these various gimmicks and the way that they emphasize certain components over others, the headline looks as though inflation's been completely tamed. But anyone who goes to the grocery store or anywhere else for that matter can tell you otherwise.
And do you see gold re-entering playing a role in the monetary system again?
Yes, I think that gold and probably crypto on some point, there's going to have to be some kind of reset. You just can't keep devaluing your currencies nonstop without eventually coming to a head. I mean, the history has been very clear to us. The way you deal with debt is one of three ways. You grow out of it, pay it off, you default, or you inflate it away. Central banks always try to inflate it away until the pain gets too much and there has to be some kind of reset. Right now, they're in the inflated away mode. That just started. We're probably in the first or second inning of that. How long that lasts, we'll see. Currently the US is the cleanest dirty shirt, but this is a global problem.
You just made me think of a claim that an advisor to Vladimir Putin made. He made headlines with this bold claim. He says that the US's only way out to beat the staggering, $35 trillion debt is to rewrite the rules of crypto and gold market. His
Yeah.
assertion, Washington aims to erode trust in the dollar, shift its debt into a so-called crypto cloud through stable coins,
Mhm.
devalue it, and reset the global financial system at the world's expense. Now, this is obviously just his opinion. Does he
Right.
have inside information we don't know? But based on what you're saying, you think this is not out of the equation here.
No, if you look at some of the legislation coming through Congress right now with specifically related to Bitcoin, you look at what the Trump administration is doing with stable coins, it's very clear that they're trying to increase demand for treasuries and the dollar. They're very clearly trying to get investors to focus on dollar denominated assets. The reason for that is, stable coins are essentially crypto that's pegged to the dollar. And they're requiring that, if I issue whatever, $1,000 worth of XYZ coin, I have to have $1,000 in actual dollars in my balance sheet to counteract that, to peg it. And so the reality is they're trying to create demand for the dollar through crypto, which suggests they're laying the foundation for some kind of new monetary reset, which will probably involve crypto and likely gold. At the end of the day, central bankers try to downplay gold, but you have to look at their actions. They've bought over 1,000 metric tons of gold every year since 2023. They've bought 4,000 tons total, and it's actually gotten to the point that for the first time since the mid 90s, central banks actually own more of gold than treasuries as a percentage of foreign
Yes.
reserves.
Yes. Yeah.
So
But then, Graham, what happens to the dollar
yeah,
in that
so you have to
situation?
look at what they're doing, not what they're saying, and what they're doing is they're shifting into hard assets.
There you go. All right. Crazy stuff, crazy times, Graham.
Crazy times, crazy
What's
times.
I mean, what's your final words to everyone watching at home? I mean, if what do we do if
I
this
think
does play out? How do you prepare?
Sure. I think the critical thing to do is to think that we're currently in a, it's very easy to get doom and gloom and to say like the world's ending, but you need to really ride the bull market as long as you can and then get out once things roll over. So, my suggestion to people is rather than panicking now, is to allocate capital to the things that benefit from inflation, things like stocks, and especially gold and precious metals. Look to ride this as long as you can. And then once the market starts to roll over and you see it breaking down below sort of critical moving averages, things that indicate the trend
Yep.
is over, go to the sidelines, go to cash, maybe it's hard to see gold falling much, so maybe don't sell the gold, but definitely look to get out of stocks once things start getting hairy.
And on that note, that's why I invite everyone to reach out to my wonderful colleagues at RTM Trading. There's a link below in the description where you can set up a free strategy session with someone who will walk you through, getting started owning physical gold and silver.
Mhm.
I highly urge everyone to do it and tell them I sent you. They'll take extra great care of you. Graham, thank you so much for joining us.
Always a pleasure. Thank you.
And thank you for watching. Don't forget to subscribe to our channel, and we'll see you real soon.